discounted cash flow on Fun. Fun is Cedar Fair, and this company owns 13 amusement parks in the United States and Canada. And we're going to see how much a stock is really worth. So the first thing we're going to find is the shares outstanding. So I pretty much get everything from Yahoo Finance. And if I can't find it, then I'll go to the 10K. That's a $1 billion company, 1.423 billion equals 1.423. 1423, if that's correct, because that number is in millions. Let's, the stock price is 25.10, so it's just a quick way to find the shares outstanding is you go to, I mean, you can find it in different places, but I do Yahoo market cap. So you get the market cap divided by the stock price, and that's how many shares outstanding, 57. That's 57 million. Okay, now we need a free cash flow. And let's go to the financial section and then the cash flow statement. And they list the free cash flow. I don't have to do it, which is just cash flow from operations minus capital expenditures. And I have to add 3 zeros because the numbers are in thousands in Yahoo Finance. And obviously I can make a mistake, so I double check as I go. And also sometimes at the end, if there's numbers just don't look right. Next we need the net income. What I do? $178 million for 2016, 2017. Let's see the 2018 net income, 126 million. And as you do this, you do get a sense of the numbers a little bit, so you could see trends and how things go about. Because you generally want a company with a lot of cash flow, because that's how you run a business. You need money, you need to operate, you got to buy things. And if you don't have much cash flow, that could be concerning. And if your net income is low, that also can be concerning. Of course, there's so many other things to look into besides that. Revenue is important, of course. So 1.3 billion of revenue. And I calculated net income margins, which is your net income over your revenue. So, and that's 14% in 2016. So of every dollar they took home, or their net income was 14 cents. So the higher the better for that number, because when you have sales, you want to take as much, put as much in your pocket as you can, or give as much to the shareholders as you can. And if most of it's going for, you know, your operation expenses, then you might not have a viable business. You need to have money left over for the shareholders and for growing the company and many other things. So now let's enter, so you can see the market cap is here, it's calculated, so that's a good double check. So I can always go back to the summary section in Yahoo. Market cap is 1.4 billion, and that's correct. So I did everything correct on up here. interest expense, we have to go to the income statement for that. That's the interest on the debt, $100 million. Short-term debt, that's that's just debt due within 1 year, 7.5 million. Long-term debt, that's debt due more than 1 year, which tends to be more. In this case, it's a lot more. 2.2 billion. Or 2.1 billion. So they have 60% debt, 40% equity. And the way that that's calculated is the equity is your market cap, which is 1.4 billion, and the debt is what we input from the balance sheet, which is roughly 2.1 billion. So there's more debt than equity. And the interest on the debt, so obviously that can't be right, because it can't be that high. So let's see, 7 million, and it's 2 billion of long-term debt. Interest is 100 million. Yeah, 100 million. How did I don't know how I put 1,475 in there. Where that came from. Oh, I took the revenue. See, that's what happens when you go too fast or you're talking, you don't pay attention. Okay, so interest expense is 100 million, and the debt. So that looks appropriate, 4.66%. That's about right. You'd expect debt to be anywhere from like 2 to 10%. And the bigger the company, the lower the debt, the better terms they receive. Income before tax, 215 million. Income tax, 42 million. So that's right, because I'm expecting 20%. Like the reason I put, if not sure, put 20, because sometimes you just can't find the info, or you can't back into it, so you just put a fixed number of 20%. But that's correct. I don't have to look into the 10K or be concerned about that number. Now the beta is the volatility of the stock, 1.9. So every time the S&P goes up 100, this stock will go up 190. And when it goes down 100, it will go down 190. So the CAPM, capital asset pricing model, will figure out your return on your equity on your stock. So it's 16.91%. And this is the formula. It just uses the risk-free rate, your beta, and the market return, and calculates the CAPM. And then in order to get your WACC, your weighted average cost of capital, you need a blended rate of your debt and equity. So it's going to be, the number will be a little closer to debt, since there's 60% debt. So it's 8.98%. That's what you have to discount your cash flows at, because that's how much it costs this particular company when it wants to borrow or get money. It costs them roughly 9%. So like if you had a home and your mortgage was 4%, your WACC is 4%. Now if you had credit cards at 17% and your mortgage at 4% and your car loan at 8%, your WACC may be something closer to like 10%. So we're discounting the future cash flows at 8.98%, and we're doing 2020 forecast, 2021, 22, and 23, and then we do a terminal value because you can't go forever. So you generally do a terminal value, which is a one-time value of the company after 2023. And that's the formula if you want to look at that and figure it out. So terminal value is $3 billion, and with the discount factor of 1.4, if you discounted that back to today's dollar amount, that's 2.1 billion. So the future value of the company is the sum of these numbers. 156, which is the present value of 2020 and 2021. So that's how much the company's worth today, $2.8 billion. And if you divided that by the number of shares, you get an estimated stock price of $48, which means this is trading at a 48% discount. So it looks like a buy. Now, of course, there's a lot of other factors involved. People may say, well, it's a buy according to the numbers, but with coronavirus, it's probably not going to make any money for like 2-3 years, or hardly anything this year, a little bit next year, who knows? So you may not want to buy it because maybe a lot of people aren't going to be going to parks. So whenever you look at a company, there's quantitative, which is this, looking at numbers, and qualitative, looking at other factors, not just numbers. So I hope you like the video, and make sure you subscribe and like and leave a comment.